Hello, and thank you for watching our latest quarterly asset allocation update. Now, if we look back over the last quarter, what we can see is that inflation fears have continued to recede. We've also seen that central banks across most developed markets have continued to cut rates. And finally, the global economy has remained resilient. So a pretty positive economic backdrop. But the question is, if we look towards 2025, what does that look like? Now, from our perspective, the major things that we are focusing on at the moment are threefold. Trump, and yes, Trump. The macro discussion currently is being dominated by President-elect Trump's policies, the effects that these may have, and the retaliations from other countries. Now, the problem is, none of us actually know what will be implemented and when. That makes forecasting exceptionally difficult, and we have to acknowledge that a degree of humility is required. What we can say, though, with greater confidence is that some of these policies, if implemented, could have very significant impacts on global economic growth, on US inflation, and of course, corporate profits. Now, a big question for investors is whether we might once again have a bull run in US equities, similar to what we did in 2016 and 17 when Trump first became president. Now, yes, it's possible, but in our view, unlikely. Why? Well, the setup today is very different to what it was back then. Firstly, valuations are significantly more elevated. And no, that's not simply across the Magnificent Seven. We've also got sentiment, which in our view is overcooked. And then, as noted, a rather puzzling policy outlook. Now, valuations in and of itself is not a reason to sell. They simply point towards the risk-reward trade-off. And we also do need to acknowledge that things like deregulation and tax cuts would be positive for US businesses. Return expectations must be realistic, though, especially for Australian dollar-denominated investors. By investing in the US, we've had the best of both worlds. We've had higher markets, largely driven by multiple expansion, as well as a weakening Australian dollar. Now, unfortunately, in terms of sustainable drivers of future returns, multiple expansion and currency weakness are not trees that grow to the sky. Now, the risk for Australian investors is that at some point in time, both of these dynamics will start working against them. On a more positive note, the global earnings recovery is underway. More companies in more countries are growing their profits. Now, combined with this, valuations in other regions are also more reasonable, which means there are opportunities for us as global investors, including in smaller companies. This keeps us neutral, the asset class, though we are closely watching global inflation trends, especially in the US. Why? Well, if we look at 10-year Treasury bond yields in the US, they ended the year almost 1% higher than where they were when the US Fed first started cutting rates. This is actually the opposite to what would have been expected. It seems that bond investors are demanding a risk premium to account for uncertain geopolitical risks and increasing fiscal largesse by the US government. Rising bond yields represent a growing risk to equities. And like 2022, they may be the spark that cause equities to become cheaper via multiple compression. Importantly, in such a scenario, bonds may once again fail to provide a cushion to falling equity markets. At home, inflation remains above the RBA's 2 to 3% target. Nonetheless, interest rate cuts are coming in 2025. Given high all-in yields, we continue to prefer fixed income across a defensive asset class, but remain wary of adding duration or interest rate risk at this point. And with credit spreads still at multi-decade lows, we continue to be wary of lower quality, less liquid parts of the fixed income market. Finally, while interest rate cuts may provide a boost to our sluggish economy, Consensus forecasts for earnings growth of the Australian market remain negative heading into 2025. Combined with this, valuations are still well above historical averages, and our largest sector, the banks, are especially expensive. In addition, the dividend yield in the Australian market is no longer as attractive as what it has been historically relative to other alternatives. Combining all of this, we think that there are better opportunities for investors overseas. As a result, we continue to remain underweight this asset class. To conclude, none of us have genuine insight into when we may experience bouts of turbulence, but we do know that 2025 is likely to be unpredictable. The data continues to positively surprise, but markets are priced for perfection. Against this backdrop, the potential range of market outcomes is wide. In our view, this argues for diversification to be able to weather whatever the markets throw at us. On behalf of the Elston team, thank you for your time. And if you have any questions on this update, please don't hesitate to contact your advisor.